Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and today I'm joined here by my colleagues, Keely Joe.
French. Hello.
Okay, I could just say Keely Joe, but French works. I mean,
no, it's okay.
That's actually part of
the name.
I didn't
know if I couldn't remember if you do my whole name or if you just do Keely Joe. I just wanted to throw it out there.
It's been a while. and then my other colleague, Jacob Messick.
Troy, it's May, which means high school sports are finishing up for the spring. Spring sports, track, soccer. Can I get a Go Grizzlies?
For who?
From you. Can you give me a Go Grizzlies?
Who are the Grizzlies?
Who are the Grizzlies?
The Grizzlies are the team of Future Focus, right?
What?
Yeah. I'll give you a KP because I think I knew who the Grizzlies are. I'll give you a KP. I can give you a lot of things, but all right, go Grizzlies.
Go Grizzlies.
All right.
What sport are we even talking about?
All high school sports. Spring sports.
In Nebraska.
Yeah.
In Nebraska.
Everyone's going to know who that is.
Yeah. So this is listener episode number 3. 25 episodes. That's crazy. And it's when you think about it, that a little over a year ago, we were going, hey, let's try to do this and all that good stuff.
I was going to start the episode wishing you happy anniversary, but didn't know how that would play. So.
Yeah, that wouldn't have gone over well. Okay, so here's the way it works. We have questions that listeners have submitted, whether that be through our YouTube page, whether that be internally through the company. However they get the questions to us, we read the questions and we answer. And it's a great way for us to stay connected to you and to answer contemporary things that actually have people worried, or dare I say, keep them up at night. So let's start. Let's start with a question that's probably going to set the stage for the theme of these 3 or 4 questions. Okay. Question number 1. I'm 53 and I've been saving in my 401k for years, and I think I'm doing what I'm supposed to be doing. But the truth is, I've never really put everything on one page to see where I actually stand. How do I know if I'm on track?
I guess I would start and say on track. For what? I think it's hard to know what your goals are if you don't, know what you're trying to accomplish. So I think the first part is thinking, what am I trying to be on track for? But then I think it is hard if you haven't put everything on one sheet to review kind of where you're at. It's hard to know where you're going. I guess I'll kind of leave my answer there, let you respond, and then before I kind of provide some additional context to what my thought is.
Sure. I would say, honestly, you're in the majority if you haven't spent the time to put everything on one page. Everyone kind of does those things where they know they're doing like the right parts of everything, but they don't necessarily put it all on one page to zoom out and see the big picture. So I would say, first of all, don't panic. You're doing okay. You're doing fine. But I definitely agree that maybe the first step here is to start mapping that out and putting it on one page. And I know we have different methods to do that, Jacob. I don't want to take over your talking points, so by all means, I'll let you
go for them, and we'll see.
Would you 2 quit being nice and answer your question?
We'll see. To me, there's three things that come to mind. We'll see if you can go 3 for 3.
Okay. So the first thing I would say is the balance sheet.
Okay.
What you have and who you owe, essentially, is where that goes.
Of course, the accountant would go to the balance sheet first, but go ahead.
It's important. So what you have and what you owe. That's really good, just mapping out your assets and exactly what you have. The next one I would say would be the cash flow. Again, just the statement of cash flow. Have to keep my accounting stuff. Essentially, what's coming in and what's going out, your actual day-to-day. And the third one, and I'm trying not to look at my notes so I don't cheat, I can't think of, so please fill me in.
No, I think it's budget, it's net worth, it's cash flow.
Yeah.
It's those 3 things. If you haven't done those, starting to track those lets you kind of know, hey, and then thinking, what do I want if I'm saving for retirement? What do I want my retirement to look like? The cash flow statement lets you know, hey, here's what's going out currently. Is that the same level that's planning to go out when I retire? Is that going to change? So those 3 things I think are a really great starting point to at least start keeping track of on a regular basis, to be able to then build off that for what goals are you trying to accomplish.
I agree.
Because then I think from there too, then it's, once you know those things, then you can go deeper into the question, say, hey, if my goal is retirement, well, what am I currently saving towards retirement? Do I have excess dollars from my cash flow statement to allocate towards my retirement goals? And then it's, and I think putting everything on one page provides some level of clarity.
Yeah. But again, don't panic if you haven't done that just yet. You're with the majority. I love the way you're thinking, though, and the way that you're going with this. You're definitely on the right track, but don't panic just now if you haven't done that.
And the other thing is when you think about the interplay of those three things, and you're thinking about retirement, what are you retiring to? Like, I don't. How do you figure that out? Like, how do you figure that out if you don't go, okay, this is what my life is now. This is what I would like it to be, and then you do this, and then you go through that process, the budget, the cash flow. Maybe you can sort of project the balance sheet, but certainly budget and cash flow, you don't know the number until you kind of figure out how you're going to live.
Well, it's like what we talked about just last week. You and I, we were for a training that we were doing. It's the mix of behavior plus the math. The behavior.
We're going to get to that.
All right.
Probably not in this episode, but I think we got an episode coming up based on that training that we did. So,
but it's the combination of two, is knowing what my goals are, and then the numbers help lead me. Am I on track? Do I need to make changes? Whether it's using online calculators, maybe you have access to an online calculator through your work retirement plan, through your 401k plan website. Maybe you're talking with a financial professional to make sure you're on pace, or if you need to make some changes. So I think those are some good starting points for that person to be thinking of.
And that's a great place for me to do two things. One, transition into the next question, because understanding sort of where you stand kind of leads us into the next question. But before I do that, I want to make sure that everything that we talk about, just a reminder that everything that we talk about, everything that we discuss, is general information. One of the things I know Jacob just mentioned, your company's retirement plan. Maybe there's calculators. There are financial professionals out there that may be of help. That's where you go to sort of seek that help and to get those specific recommendations. We are here for information only, as they like to tell us. So, all right. So let's transition into, first of all, we good on question one?
Golden.
All right.
Good.
Question number two. I'm 50 years old, and I've been contributing to my 401k consistently. How do you actually know if you're saving enough?
Well, there is no magic number, essentially. You can have a number in mind, but it's usually not going to work out that way. It's really a matter of what you want your lifestyle to look like in retirement. Does that mean you want to live in like 80% of where you're living right now? That's a common rule of thumb. Again, it's not financial advice, but a common rule of thumb, 80%. But I don't know about you. Troy and I were actually talking about this earlier. I don't want to live at 80% of my means. I want to live at 100%, maybe even more than that.
200%.
200% is preferred.
I want to redline that thing, man.
So
that's just me, right? Like 80%. Like I'm just like, I know that's the commonly held.
But that's why
that's the number.
Personal finance is personal.
Personal
so
finance
it depends
is personal.
on what you want your retirement lifestyle to look like. It's going to depend on your situation.
Yeah, I was actually talking to my fiance about this earlier. He's like, do you want to live in a mansion? If so, you better be saving a lot more. But if you're okay living in a small house, then maybe that doesn't look like you're saving as much. So it's really what you want that lifestyle to look like will determine how much you actually need to be saving to achieve that.
Is it bigger toys? Is it bigger vacations? Is it bigger travel? Is it... yeah. So anyway, like I said, for me, 80%, that one never computed for me.
Yes, it's what do you want to accomplish, and I'll take yours and expand on it. I think it's not just to that point on how much I need to save up, but it's not just that lump sum of what you want to save up. It's converting that to. It was an episode we did end of last year. Where's your paycheck coming from in retirement? It's converting what you're saving to retirement income in retirement, and so. Whether it's your retirement savings, Social Security, maybe it's a pension, it's, turning things into a stream of income to help continue to pay those expenses, whether it's your base living expenses or the extra stuff that you're trying to accomplish. So I think it's all of that is part of the conversation is, okay, how do I turn this into income in retirement?
And I think it also kind of goes back to the 3 different types of documents that we talked about in the first question of making sure that we have a good bird's eye view of what our lifestyle is like and how to maintain that in order to actually put a number down.
Yeah.
Right. Though I will say, even if you're in, I think, it's not a set and forget it type of thing. So it's reviewing it on a regular basis. And someone who's in their 50s, hey, you might still have 10 or 15.
Do you feel attacked?
No, I just feel like
I was even
every time it's like 50s. I'm like, I just feel
didn't
like
even
everyone's looking at me.
I didn't even reference you this episode. A couple episodes ago, I may have referenced you as being 50. I was trying to steer away from that side of the room being in the 50s, but you brought it up yourself. But no, so even you're in your 50s. Or this person is in their 50s, they still have time to accumulate and grow. And so those regular check-ins, whether it's financial professional, using some type of online a tool or calculator, lets you see, hey, do I need to contribute more to be able to be on pace? Maybe I want to retire early, so do I need to ratchet up my retirement savings? Because, let's say you're an employee at a company that offers a 401k. Wrote down some numbers here because I wouldn't be able to remember all of them off the top of my head. For someone in their 50s, hey, you can contribute up to $32,500 into your 401k as employee contributions.
With the catch-up, right?
With the catch-up for those ages 50 and above. For IRAs and Roth IRAs for 50 and above with the catch-up, it's $8,600. So you have capacity in 401k, in IRAs and Roth IRAs to be able to save dollars to be able to, be on pace for what you want your retirement to look like. And then that's not taking into account non-qualified annuities or taxable accounts, additional methods of saving dollars that you may want to allocate towards your retirement.
One of the things that I'm sort of thinking about and toying around with is this idea of, I got to be out at a certain age, right? What if, and I'm just throwing this out there, there isn't a right or wrong answer. What if you said, what if you said, you know what? If I find myself that I'm not at the number and it's the time that I said I wanted to be out, I just work an extra year. I just work another year and I spend a little bit more time in your 50s, maybe doing some stuff that you wanted to do.
But yeah, all those, you don't want to miss out on opportunities to enjoy life in all the different spans, in the 20s, the 30s, the 40s, the 50s. And like you said, maybe it's working an extra year, maybe it's maybe I'll do part-time for a few years, or maybe I'm going to contribute more in the in these later years, or have a little take out a little bit less in retirement in these years. So there's those fluctuations, the retirement plan is flexible. It's not it has to look like this. There's a lot of different ways to get to the end result, and it's just knowing what toggles that you can adjust and, to be able, like you said, to be able to enjoy now, but also the future.
Yeah.
Yeah. And you talk about enjoying things like now. And I just want to throw out there for the people who retirement's a little bit further away. I mean, I'm 29, so for me, retirement's a ways away.
40 comes fast.
It does, I hear.
40.
I'll be 30
I look at
this
40
year.
fondly.
But I mean, when you're around my age, you might be thinking, okay, well, how can I just save all this money? How can I put all this away? You don't have to save a specific amount. It'd be great if you do. You'd be in the top % of people if you are ahead of the game and saving as much as you can. But really just do what you can with what you have now. If that's putting away a couple $1,000 a year, that's wonderful. You are in a great spot. So just keep saving what you can, doing what you can with what you have.
Well, then even if you increase it, let's say you increase it 1% each year, or as you get a raise or promotion, you allocate a portion of that towards the savings to grow it. So there's a lot of different ways that you can build that up over time.
That's
Gotta pay yourself first.
The main thing, love that, by the way, love that. But the main thing is creating the habit of saving. And because you're 29, if you're 25, if the younger, you have that luxury of not having to have this gigantic number that you're saving, right? Because if you haven't done anything and you're in your 50s, that number's got to be a lot bigger.
There's less time to compound, and
yeah, it's Compound interest is undefeated.
And that doesn't mean like sleep on this. Like you should still put away what you can because, like you said,
Yeah.
compound interest is king here. The time is what you have on your side. That is the biggest tool in your tool belt. So make
Yeah.
sure you take advantage of it.
But all things being equal, you can't overcome.
Yeah.
So, okay. So let's talk about, now we've done the feel good piece. Like we're going to spend at 110% of our income. We're going to enjoy it all. But there are some things that dare I say, we always talk about keep people up at night. So even if people feel like they're doing the right thing, this next question pulls us into, I feel like I'm doing the right thing, but what if? What if it happens and this happens? And in this case, for question number 3, I'm about 7 or 8 years away from retiring. And one thing that worries me is the market dropping right when I retire. What happens if the timing is bad?
So I think this question, and correct me if I'm wrong, because this is not my strongest area. I have a solid idea, I think enough to be dangerous, but feel free to correct me or add to this. So I think this is more of like a sequence of returns type of question. And my understanding of sequence of returns is having different pots of money in order to take stuff from, so that when the market does drop, you have this other area of money that you can withdraw from, so that you're not actually realizing the losses when you take out from the market. So it's building in some flexibility in the type of funds that you have so that you can actually ride out those times where it's a little bit rough.
I think,
That's pretty good.
Pretty good. I think the piece that I typically expand on is it's that timing, either kind of right before or right as you're starting retirement. If you get hit with a downturn in the market right when you're starting to retire, that's going to have a stronger impact than if a down market happened later on in retirement.
Yeah.
So that's where for this person, and as you mentioned, it's probably a good time for us to say, hey, just general information, not advice. But for this person, that's where there's a couple things that come to mind is really key. It's asset allocation, making sure where your funds are at, what type of holdings you might have.
But not just asset allocation.
Matches your risk tolerance.
Okay.
So that depending on how what type of risk you're able to willing to have, it matches. But then it's also just diversification, having those holdings across different account types and different.
Right. There you go.
Yeah.
There you go. That's what I was looking for. Like there's all sorts of there's tax diversification, there's account diversification,
Asset location.
there's asset location, asset allocation. All those things taken into account, we try to help stave off and deal with sequence of returns.
Yeah. Which
asset risk.
Which also, if you're younger, hey, you may be willing to be more risky, take on a stronger, higher risk tolerance than someone who maybe is close to this person, 7 to 8 years away from retirement. Maybe they're wanting to dial back that risk tolerance so that way it's less impactful for them. But that's why reviewing things on a regular basis, making sure where you're at, what you have matches what your tolerance actually is in your current situation, is something to review on a regular basis too.
And even harkening back to the 2 weeks after you retire, where's your paycheck coming from? That episode, that's that diversification of how you're going to decumulate your portfolio, how you're going to actually spend those dollars. So all of that comes into play. All right. So let's go to our final question.
Oh, before we do.
Oh, here we go.
No, we got a listener question. This one, it's from Andy in the Midwest. And so,
what's his name? Roy Ranch?
No, Andy from the Midwest
okay.
has a listener question.
Right.
Summertime, this is an easy one. Summertime. It's in Nebraska. It's hot. It's humid. So if you're looking to escape Nebraska at some point in the summer, you go into the beach, you putting your toes in the sand, or you going to the mountains where it's a little bit cooler.
Mountains.
See, I'm summer, I'm beach.
Nebraska's hot enough.
Why would I go where I'm
beach?
based in my own juices?
See, I was going to. If you guys would have said beach, the next question would have been.
You obviously didn't ask this ahead of time.
Crocs or sandals
Crocs.
in the summertime.
I'm a huge fan of Crocs, especially the sports mode. You can do so much.
No way. there isn't a world in which you're going to catch me in Crocs.
Crocs are the best.
So your
No.
sandals?
They are so underrated.
Oh, I'm
Yeah,
slides.
You have active mode, sports mode on Crocs.
Sports in the wintertime, you can get fur-lined ones. Crocs are amazing.
So you're a sandals guy.
I am
I'm gonna buy you.
I'm
a
not
pair
a
of Crocs.
sandals guy. Let's just be. I'm a like slides guy. I'm not slipping into a nice high back sandal. I'm good.
I
Tube
know what I'm
socks
getting
with
you for
sandals.
Christmas. Or your birthday's coming up. I'm gonna get you some Crocs.
Excuse me. What? Say that again.
Tube socks with sandals. The high knee ones. You a socks and sandals kind of guy too?
God. No, I'm decidedly not a socks and if you ever, you and I are somewhere and you walk out with Crocs and
Crocs and socks.
tube socks, you will not be allowed to walk with me.
That might be some podcast attire here later this summer.
Anyway.
All right.
All right.
I think the transition was finally last question.
Finally, last question. Okay. All right. Okay. You just kind of threw me off. Okay. So here's question number 4. Socks. Oh my God. Socks and Crocs.
You know what I'm getting him for his birthday.
Okay. So finally, are there some concepts? Stop.
You're good.
Finally, there are some concepts people hear about that create confusion well before retirement actually begins. That's sort of the transition, guys. So I keep hearing about RMDs and how they create tax problems later. What are they, and should I already be thinking about them?
I'll take the second half of that question first. I know we got you flustered because you were having to read that word for word from the notes.
Normally I don't read word
not
for
very
word.
often. So, but all right, second half of that question: should I be thinking about them?
Should we define them first?
Yes, I'm going to answer the shortest answer ever. Yes. Should you be thinking about them? Yes, but let's define them.
So RMDs are also known as required minimum distributions. And essentially how they work is when you have a tax-deferred account, like your retirement accounts, where you're not paying tax on it today, but you're paying tax on it when you withdraw in the future. It sits there for a while, and the government wants to get paid at some point. So they don't want you to just sit on it where they're not getting any money for their tax dollars, where you're deferring that income for an indefinite period of time. So they've introduced this concept called required minimum distributions, where when you hit a certain age, you have to start withdrawing some of that money so that the government can get their payday. They want to get paid, so they can start taxing you on it. Now, they tax it at your ordinary rates, which is just your personal rates that you get taxed on when you have income. But generally, all that money is deferred until you start taking it out. So the government's like, okay, you reached a certain age. And for those of you who are wondering, if you're born after 1960, that age is 75 when you have to start taking that out. So it is well on later into your retirement. You don't have to take it out immediately, but it does have certain consequences. And I will stop there. That's my definition. Do you have anything to add?
No, I think that for defining what they are, I think that's exactly right. We talked about this before: taxable, tax-deferred, tax-free accounts. Tax-deferred accounts, majority of people know what those are: 401ks, 403bs, IRAs, simple SEPs. All of those, potentially, you're able to fund those on a pre-tax basis. And then they're growing tax-deferred, and you got to pay taxes on it at some point. Why it's an important conversation is that's taxable income in retirement. Those RMDs, depending on how much you have in a tax-deferred bucket, those RMDs could be pretty high, especially in the later years, which that could push you up into a higher income tax bracket. Maybe it's impacting, how much of your Social Security benefit is taxable, could impact you, could increase your Medicare premiums as well too. So
we should probably tell people the reason why is because the government says the government not only says you have to take them, but the government also mandates
how much
you have to take.
Mm-hmm.
So there's no middle ground.
There's a table with factors.
74-year-old, the number may be different because the accounts are different, but a 74-year-old that has to take a certain percentage of their account, a 75-year-old, and so on and so on and so on.
You don't get to pick what it is. There's a factor, there's a table that base off, hey, this is what that RMD for, say, 2026 is. And so that and then one thing that comes to mind too is it's not just for you, but if there's any funds, any balance left over in a tax deferred account, when you pass away, your beneficiaries, whoever your beneficiary of that account is, they get that account balance, but they also have to pay taxes on that. And, if you're, typically for most beneficiaries, if you're a non-spouse, for most non-spouse beneficiaries, you have to deplete it. You have to take it out at least by 10 years of that individual's date of death.
And this is also where RMDs come in. So yeah, you have to deplete the account within 10 years, depending on who you are and what your relationship is to the deceased. But if let's say the person who is deceased had already started taking out those required minimum distributions, well, that means you have to continue them. Because again, the government wants their money at some point in time. So if they pass away taking out those required minimum distributions, the government wants you to continue making those payments and taking those out. Now, let's say they pass away without already starting the RMDs, the government's okay with you deferring it because they know that you're going to have to deplete the account within a specified period of time. So if RMDs have already been occurring, when they pass away, you have to continue them. If they haven't, you don't. You just still need to deplete the account within the specified period of time.
So that's where RMDs themselves, they're not technically a problem. I mean, it's just being aware of the situation, being aware of what tax deferred accounts and what RMDs mean. From an efficiency standpoint, is it the most efficient? Maybe, maybe not, depending on your situation. But being able to work and to manage those early on gives you control of your situation, especially if you're thinking, hey, maybe would I rather have some tax-free dollars in retirement versus all tax deferred? And then, if I'm, depending on what you're drawing down, if there's funds left over, how do you want those to go to your beneficiaries and your heirs the most efficient and effective way possible? So it's just being aware of what that impact is lets you help you control your situation.
Mm-hmm.
Yeah, and it's when you talk RMDs, understanding them, they become not a problem but a nuisance as we think defer, because that allows us to get bigger, compound interest, all the things we just talked about. And then you defer, and then all of a sudden you're like, well, my behavior and my lifestyle is adapted. I'm good with the dollars that I'm able to get access to, and I don't necessarily need to access those tax deferred dollars because defer. And then all of a sudden you get these giant RMDs. Giant is relative to the account. And what do you do? And all the things you talked about earlier, Irma.
What was that?
Basically, there's a special health premium that's determined by your income in retirement, and you have to pay this additional premium, and it's based on income. And the more income you have, the higher your health premiums are. That's what Irma is for the normal person. So unfortunately, yeah. Anyway. That ticks me. That one makes me mad.
I'm just happy I'm not the one with the most pebbles in the jar. I think
that's
we're even
where
now.
I think talking with a financial professional who's able to help, who's able to help you compare. Hey, let's say you are an individual like this person who's thinking about RMDs because they have a large tax deferred account and balance. Hey, a financial professional is able to help you say, okay, if you continue down this path, here's what this looks like. But maybe there's some planning opportunities to do Roth conversions, to do some planning that might mitigate your exposure to RMDs.
We're going to call Roth conversions?
No, because we just talked about it just recently.
Yeah. Mm-hmm.
What if they didn't listen to that episode?
Better. I guess. No, so Roth convert. Tax deferred, tax free, taxable. Roth accounts are in that tax free component, and so it's the ability of shifting. Following the right situation of shifting some of your tax deferred dollars, paying taxes on it now to shift it over to a Roth account, so that distributions, withdrawals that come out of it at a later date is tax free.
Right.
So.
All right. So this was good. This is listener episode number 3. Hopefully through these questions, this definitely had a 50-year-old retirement feel, and that was sort of by design. Those are the questions that I specifically pulled out. But hopefully if you have a feel and you're sitting on the other end and you're wondering, am I behind? What am I doing? What should I do? Hopefully what you gathered is that anything that happens or any difficulties that you may be going through is not because there's a lack of effort on the folks that that had questions for us. It's almost like a lack of clarity. What should I do? What should I what should I do? How should I be doing it? Am I doing the right thing? What happens if? Those are where the questions go as you move into your 50s. So if you're feeling that way, don't worry about it. I want to thank everyone for your time and attention. Listener episode number 3, episode 25. I'm Troy Branch on behalf of Future Focus. It's been a while since we've done this, so I'm just so happy. So hey, thanks everyone. Again, appreciate your time and attention. We'll see you on the next episode of Future Focus. Oh, I forgot. Got to continue to remind everyone. Make sure you like and subscribe. So that way you all know when a new episode comes out. You can comment on in the comment section below to ask your questions. And I'll just tease everyone. We got a little bit of a surprise coming up. I don't know if I'm able to announce it, but we got something special coming for you in the upcoming episodes. Thanks everyone. Have a great day.